Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and we are coming to you live at 5 p.m. Eastern Time, as we typically do on a Wednesday. Today is Wednesday, September 24th, 2025, and we've got a newish guest. Jack Kosar has been on. His father, John Kosar, has been on a number of times from Asbury Research, but John was kind enough to bring Jack on a few episodes ago, and getting Jack involved. Jack, of course, is the VP of Investment Strategy at Asbury Research, and he kind of does a lot of other things. But one of the things that your father has said a number of times that he really appreciates that you're bringing to the company is this whole quantitative research element that you went to school for. So nice that the college education is paying off, and we're going to get into it. So thanks for being on the show, Jack.
Thanks for having me. Yeah, no, he always says he's got 40 years of intuition, and when he needs something tested, he throws it my way.
Yeah. Well, and that's so interesting because I worked for 15 years or something as the assistant to William O'Neill, who was the founder of Investors Business Daily. And yeah, I found the same thing. A lot of times he'd have an idea, and he'd be pretty spot on, but I'd have to do like a month's worth of work in order to, come up with all the data and be within like 0.1% of what he said at the beginning of what his guess was. But it's always nice to do it the right way. But let's talk a little bit because again, your dad's been at this for a while, but you have started, and again, you're kind of there's a lot that a lot of people are saying like, oh, the market is different now. There's all these new instruments, there's new things to look at. It's moving faster. So have there been any things that you've kind of brought to to the attention of someone as experienced as your father to say, oh, you know what? Here's the way you've been looking at things, and this might be a little bit different than what you're used to.
Yeah, I think it's a lot of it's variations on the themes, and like you said, it's a lot of the same tools that he was using, but maybe directing it a little bit differently. We've been
Hmm.
pulling up recently. A lot of leveraged ETFs have been coming online. I think 2x Qs is one that we've been mentioning lately, and just having that, using the same type of relationships that he was using, but maybe some of the newer tools to understand what direction the market is, what kind of where investors are going. Yeah, right here we got QLD, which is 2x Qs. We take the total net assets relative performance versus the QQQ. And really what I'm trying to do is figure out what the risk appetite is for investors.
Hmm.
If, as we can see when in the top panel of the chart is as the line's going up, that means investors are seemingly willing to take on that extra leverage versus when the chart's going down, they're kind of retreating back to the Qs, or at least the Qs are outperforming its two-time product.
Hmm. And so this is data as of yesterday. Is that correct?
Through yesterday.
Okay. So when do you kind of get like a neutral reading, or what tells you, oh, you know what? Either number one, that the risk appetite has maybe gone a little bit ahead of itself, or number two, that the risk appetite is, I mean, we certainly saw that in the beginning of the year, that it certainly seemed like the risk appetite really got into a suffer situation. So how do you kind of use this to say, oh, something's different here?
Yeah, our tactical timeline for Asbury Research is 21 days. So we have that red line is a 21-day moving average. And when
Hmm.
we're negotiating that 21-day moving average, I tend to see things that are a little bit, teetering, right? You kind of look at July and August, Qs were more or less sideways. We were making fresh highs, but very much incrementally. And the top of that chart, we were negotiating that 21-day moving average, kind of hovering around it. It's not a hard and fast rule. I'm not necessarily trading when it's below, or selling when it's below, or trading when it's high. But in general, just kind of using it, that 21-day negotiation to understand. So right now, things look, as of through yesterday, things look golden.
Hmm. And do you ever find, again, when does the leverage start coming in? When do people start thinking, oh, you know what? The Qs is not enough. I need more. I need QLD. I need TQQQ. Because it's interesting to see. Of course, we had the the major correction with the tariffs in March and April, and of course, as you would expect, the appetite for leverage was way down there. But it seemed to kind of come up pretty quickly off the bottom. Is that typical that you see people like so eager to get in at the bottom that the leverage starts spiking pretty quickly?
I think so. We seem to really be in a buy the dip. Kind of we hear that anytime the market's down, even a little bit. The people on financial TV start screaming buy the dip, and you can kind of see that in the chart a little bit coming off of those April lows. The slope of that relative performance line was pretty steep, meaning that people were definitely flowing their money a little bit more into those levered products than they were just into the traditional Qs. So it seems like when we have those deeper slopes, the risk appetite is quite a bit higher, and the chart kind of speaks for itself.
Hmm. And one of the things you and I were talking about as we were kind of preparing for the show, uh, for a number of years, we would use margin debt as kind of a gauge, and at least for us, we used it as kind of a secondary or even tertiary indicator to kind of let us know what kind of environment we were in. And
Yep.
it's not that we're looking at, oh, the margin debt is, the highest it's ever been, because I mean that almost always happens unless you start making adjustments for inflation and everything like that. You're always going to get that number higher, but we would do a year over year. The problem is that we're kind of scratching our heads a little bit because there is so much use of leverage now. You have, I mean, it was one thing when you had the TQQQ, you had the QLD as ways to get a little bit more leverage on the indexes, but now you have leverage available on single stocks. Hey, you want a little bit more boost in Nvidia? Well, guess what? You can you can do a boost in Nvidia. You can get leveraged on Bitcoin, Tesla. You name it. And it's crazy to me how even some of the newer issues have already gotten single stock leveraged ETFs or ETNs on them. So, is that something that you are looking to capture any of that single stock as well, beyond just the indexes?
We do run it on the mags. So I think all the Mag 7 have a leverage product now. And
Hmm.
again, it's not necessarily something that we're exactly trading at. Asbury, we tend not to do stocks, but in general, to see the direction of the market with the mags being such a large portion of the S&P 500, seeing that willingness to take on that additional risk, meaning there's a positive outlook in general for those stocks. So we will run those comparisons. We call it the 1 times 2 times, and it's something we actually look at every day just to see the appetite. And again, to compare to, like you said, the margin accounts or the margin balances. With the ETFs, it's so easy to trade now. You can kind of get in and out
Hmm.
of those things. So we also use them as second and third type indicators, but we like to think it's a tip of the spear. And your willingness and ability to get out of those ETFs in such a quick fashion, that's why we throw the 21-day moving or 20-day moving average on it, because we just want to see tactically what direction these things are moving and kind of how they're acting with each other.
Hmm. And how far is your data going back on some of these things? The reason I ask is because I'm just wondering if there's some generational elements too. I would imagine for a lot of the baby boomers that are retiring now, and maybe even some of the Gen Xers coming up, uh, you they've got a lot of assets, but they might not be wanting to use margin as much. They're kind of in a little bit more protective mode as opposed to your, Gen Zers and millennials who might be like, hey, I've got a lot of runway. If I can punch this early on, I might get that financial independence, retire early, the fire movement going. Is there any of that demographic, generational stuff that you've seen, or is that kind of really hard to parse out?
I think it's hard to parse out. I know for me, a lot of the stuff that my dad's been doing over the years, I've actually figured out, what if we throw a little leverage to this to
Hmm.
try to bring up the newer demographic, right? I
Hmm.
well, like, we always go back to the risk numbers too. A lot of our models are very risk sensitive, so I can take on a lot more leverage using some of our models and still keep myself. We have one of our models that we're managing. It's Asbury Aggressive, and it outperforms the market 6-7%. And the important part really is though that that the risk numbers are significantly still under the S&P 500. So if I'm willing
Right.
to take on S&P 500 risk, I can throw some of these levered products on and get that upside return and still kind of keep myself protected on the downside. Data wise, kind of going back to your question, we really try to stay in a 5 to 8 year time range, just because a lot of the debt cycles and a lot of the different, new parts of the economy aren't necessarily applicable. It might rhyme to something that happened, 20, 30, 40 years ago, but it is a little bit of a new paradigm. And with a lot of
Mhm.
these new products, we're just kind of focused on that 5 to 7 range.
Yeah, totally makes sense. I also want to kind of bring this up. Of course, a lot of people use, again, kind of on the psychological market indicator side, the VIX. It's known as the fear index.
Yes.
You have started using more the VXX. Could you explain why?
We noticed that there were some wiggles. We would see wiggles in the VIX. Again, we use that tactical 21-day moving average to kind of highlight when we see directionally where things are going. And the VIX was biting a little bit too often. I don't know. I don't know what the underlying reason was what that was for. But we found that this VIX which is the short-term futures. It's an ETN, and it just seemed to adhere a little bit better to what the market was doing. I don't know if that was the nature of the market being seeming a little bit more short-sighted. We seem to see
Hmm.
moves that are, reaction to earnings are seemingly more aggressive nowadays. Reactions to things that's going on in Washington seem to affect the market a lot faster than they maybe had in the past. I've only been in the business for 10 years, so I'm speaking somewhat to my experience and then somewhat
Yeah.
to what I've heard. So, but the VXX it just seems to be a little bit better aligned to what the market is doing. And I
Yeah.
think it's that short-term nature of it.
Right, makes sense. And now another kind of element here, again, a lot of this is just kind of letting you know what environment you're in. You'll do a comparison of the GBTC. This is, of course, the Bitcoin trust, and I mean, before all of these ETFs came out, the IBIT and everything else. I do have a position in IBIT. This was kind of, if you wanted exposure without getting a wallet or finding a custodian, GBTC was the one-stop shop. So why do you use this as a measure of kind of that risk-on idea?
Yeah, so I look at Bitcoin. We don't at Asbury, we don't advocate necessarily trading any Bitcoin. We're a little bit more traditional in that aspect. But I look at GBTC as really a speculative asset. Some people say that it really doesn't have any kind of underlying value. Its value is that of what the market believes it is. There's obviously a fixed amount of Bitcoin out there, and that affects the price. But how it is versus ag, which is the bond fund has kind of a tangible valuation. So the way I look at it is looking at Bitcoin as when the market is really ripping and roaring, speculation is high, and people are really willing to take on that additional risk because they're going to think they're going to take on that additional return. And when GPTC is underperforming, in this case, when it's under its 21-day moving average, which it has been, people are a little bit less willing to take on that risk, or at least that's how we see it.
Hmm.
Now, obviously, that if you look at this chart and if you track when ag started to really kind of outperform GBTC, we still made fresh highs in the market. I don't have the data, doesn't go back too far, but the last time that this happened, it's off the screen, unfortunately, but it took a while before the market to correct after. So it's kind of a leading indicator in this sense. The music's not over yet, but maybe that full throated, ready to invest is maybe taking a little bit of a step back.
Hmm. And what happens when you kind of get some of your indicators showing, I don't know, a mixed message? Because as we saw from the QLD chart, oh, the appetite for leverage is good. Risk on, let's go. We look at this chart and it's like, oh, well, this is kind of giving us a different picture. So how do you kind of, um, square that up when you're trying to make a decision?
We stack them. So the way I like to look at indicators is not one indicator is ever going to work 100% of the time. Everybody's looking for that golden indicator, and it's invariably going to at some point trip up. So we like to stack indicators. We might stack 5, 6, 7 indicators, ideally disparate ones. I don't want 7 or 8 relative performance ones at the same time. But if I can stack multiple at a time, I can kind of diversify away some of the times that they're misbehaving, or maybe they're too early or too late. So I don't ever like to hang my head on one particular indicator. In this case, if I'm looking at GBTC, it's been a little bit offsides, or counter to what the market is doing, counter what I expect it to be doing. So I might throw a different risky asset. I might do a 3 times QQQ and do that relative performance and see how it's going. Or like earlier, we had QLD versus QQQ. So right now, I have more indicators telling me that the market looks okay than looks bad, but I don't want to ignore these either, because some of these could just be, tip of the spear, and the rest of the market hasn't adjusted yet.
Right. And as you said, especially with the GPTC, it could be leading potentially and saying, okay, you're going to see the trouble here first, and then it's gonna trickle out everywhere else. So yeah, so very very interesting. And so, how long have you been using some of these? And you mentioned back testing. How far have you gone to back test some of these and kind of again understand their usefulness?
I've been using these probably for the better part of a year. We
Hmm.
like to keep a lot of things internal for a while, just because I want to see the machinations go over. Our back tests again tend to go 5 to 7 years. GPTC does not go back that far, so I think I only have
Hmm.
2 or 3 years on this one. I've always brainstorming for new ideas or new risk assets to compare to less risky assets. So, but yeah, we do a lot of our back testing, and just trying to understand, is it a good indicator, and how it could fit. We tend to we joke, we do a lot of analogies, and we build a lot of our indicators, a lot of our models, kind of like we would build a baseball lineup. And I want to see the different underlying statistics. Is this one
Hmm.
got a level standard deviation? Is it keep my Sharpe ratio high? Is this a pure alpha returner? And I can kind of put those together to get all my pieces to get a good lineup. So this is something that I like to put together in a lineup of things. Me and my dad differ sometimes, a little bit less on the crypto with his generation. Something that's maybe a little bit more my speed. But
Hmm.
it is, I think, having that difference of opinion too between me and him, is good too. So I can learn a lot from him, and he can maybe learn few things from me.
Right, perfect. Well, shifting gears a little bit, I want to kind of take a look at getting down to the sector spiders, because that's where Asbury Research has kind of shined. That's where you do that research, you take a look at the asset flows, and kind of build your models in terms of, okay, this is where the money's going. Now, one of the things that you've done is a lot of times looked at the SPY itself, but you've kind of taken a different approach here. So
Yeah.
now you're using the sector spider total AUM, assets under management. Why make that shift?
Yeah, so the sector spider total AUM, you got the 11 sector spiders that make up the components of the S&P 500. But
Mhm.
we've kind of noticed there's a lot of noise in that AUM data, specifically around SPY. SPY can be used in a lot of different ways, cover hedges. It's very applicable, and we have a belief that the 11 sector spiders are maybe a little bit less used in those different fashions that are a little bit more straight investment type strategies. So we actually back tested adding the 11 sector spiders, 80 total AUM together, and kind of tracking that. And the drawdowns were a little bit better. Our standard deviation was a little bit less. It just seemed to be a little bit of a smoother, truer line to that of the S&P 500.
Mhm.
If looking at the chart right now, again, notice themes: 21-day tactical indicator for the moving average, and as long as those assets have been above the red line there, the S&P 500 is mostly appreciated in value. So we've had a couple little tests here and there, but nothing significantly dropping below. You could also use it as a tool to around tops. Going back into March, late February, early March, starting to see some assets flow out. And it was under that 21-day moving average. The S&P 500 largely was declining. So it's just been a strong tool for us. Again, it's not perfect. We don't
Mhm.
use it's. I'm not going to necessarily hang my entire portfolio on this one indicator, but as a grouping of tools, this is definitely one that we've been using as of late.
Mhm. And you kind of said that it kind of helps your standard deviation, lower your standard deviation, which again, most people, look at, hey, that's your risk side of things.
Yeah.
So how are you using this? Is it just strictly 21 day? If you're above it, game on. If you're below it, game off. Or is there kind of incremental usage? Is there ever any like, oh, the extension above a moving average line is getting into problematic territory? Just kind of understanding how
Yeah.
you're using this. Mhm.
Yeah, but truly above and below. And again, that's the reason I feel a little bit more comfortable doing that is because I'm not trading on any one particular indicator. So I'm gonna take this and I'm gonna combine it with 4 or 5 other ones.
Right.
So that might get me a signal. I might have 4 or 5 indicators that are above the 21-day moving average. That might tell me I'm risk on. I might have those same indicators, 4 or 5 of them be below, and that's going to be risk off. We have a couple of other little tricks and tools that we use to flatten out some of that noise. When we're kind of zipping through those 21-day moving averages and don't have such clean moves as we have for the better part of this year. But it's definitely a part of a tool. Just kind of using that 21-day moving average as a through line.
Yeah, makes sense. Taking a look at the CEF model itself, and again, this is something that Asbury Research has been doing for decades at this point.
Yeah, at least.
Yeah, so um, just again, your dad has been on a number of times, but just go ahead and if you can remind our listeners what CEF stands for and
Yeah.
what you're doing in terms of these different time periods to kind of get a sense of what's happening in the market and the rotation as well.
Absolutely. So SEAF is Sector ETF Asset Flow Model. We're very good at naming things at Asbury Research. And what it does is it's tracking the velocity of money through 3 time periods. So we have the 11 sector spiders, and we really want to see how that money flows through time. We
Mhm.
believe that a lot of investors can't leave the market. They can't go to cash. So they have to move their money somewhere and try to get out performance or at least value somewhere. So with that in mind, we want to track how those assets are flowing. And oftentimes we can see as money flows out of one sector, there's a corresponding move into another one. And SEAF has
Right.
really been allowing us to kind of highlight that. We've had a pretty frenetic moving between the different sectors over the last couple of months as I think investors are trying to figure out wholly where this economy is going.
Mhm.
Right now we're risk on, we're kind of on a risk on shift in the model with technology, communication services, and financials. That really popped after the Fed cut rates. So you could see kind of money flowing in during that time. We were either a week or 2 weeks ago, we were kind of defensively skewed. We had utilities, healthcare, and I believe it was consumer staples.
Yeah.
And it's really kind of a lot of moving back and forth. And but yeah, this model ranks it's kind of like a golf score. The lower the scoring, the better it is. In this case, technology is really strong. We have ones and twos across the board for an overall ranking of 4, which is the second best ranking that you can have.
Hmm. And what element maybe figures in here because again, in addition to like this rotation, and you're absolutely right, it did seem frenetic for a little bit. There was certainly it wasn't just the rate cut itself, but the lead up to it, where I mean, it really kind of I felt like started in Jackson Hole to a degree in August, but you really had the small caps coming on pretty strongly. So is there ever a way to kind of capture that section, as opposed to the sectors, technology, staples, and all that, going to more of a mega cap, which look, the as you said, the Magnificent Seven has been kind of where it's been at here for a while. Is it the small caps turn? Small caps have just been down in the dumps, and especially in 2022. Um, do you look at anything to kind of gauge that part of the market?
Uh, Not with the SEAF model in particular, but we,
Hmm.
we do have a separate model that will kind of dig into um, where we see asset flows along with relative outperformance. I believe that's our sort report that we can kind of point to having where those flows go. But in terms of, yeah, here we go.
Hmm.
So this is our sort report. This actually goes out to our Substack subscribers. But it points to a couple of things. We call it the 3-legged stool of investing. We got trend, relative performance, and money flows. You want to see price head in your direction. You want to see something that's relatively outperforming the S&P 500. Otherwise, You might as well be in the S&P
Why bother?
500. And then you want to see conviction with the money flows. You want to see people betting with their feet and their dollars. And as of late, small cap has been popping. So is emerging markets. And as you can see here, we also have big tech and gold. So we're kind of, I've been seeing this as investors kind of riding the fence. They're on a little bit of both sides. They want to ride out this technology. QQQ made all-time highs, I think, within the last week. And but it seems that there's some apprehension there, so they're looking for some value. Otherwise, like you said, small cap's been underperformed for quite a while. We're starting to see that turn up, and as of right now, it's green across the board for our short report.
Now, it's hard not to notice the position of gold here. This has me scratching my head a little bit, right? Because you usually think of gold as the hedge, and again, sometimes Bitcoin and sometimes gold, the correlations that you expect just don't come to pass. So, how unusual is this for gold to be doing so well while the Nasdaq 100, the Qs, are getting to new highs, while the small caps are getting to highs? Again, it looks like a strong market, and gold is doing well too. Uh, what does that say to you?
Apprehension. People are
Hmm.
worried. All bull markets have to end at some point, right? I'm not calling for a top here by any stretch of the imagination, but I think geopolitically, things going on with tariffs, just things going around the world are making people concerned, and whether it's the right investment or not, gold feels like safety sometimes. So I think having this trade is kind of unique to me. You have people that are going to have positions in big cap tech and gold at the same time. So they want their cake and they want to eat it too. So it's kind of a hedge almost. I think there's too much apprehension in the market. There's too much confusion and people are a little bit concerned. So flight to gold. It sounds
Yeah.
safe to me.
Right. And again, it's now the other question here is, if we start correcting in the market, does gold correct with it, or does gold go even higher? Because uh, again, that apprehension is kind of like, oh well, we were right, and got to go more to that.
That's tough. I think gold in general has a relatively strong correlation to the S&P 500. I don't think it's
Mhm.
super tight, but it's enough. So, it's hard to say. We try not to speculate at Asbury Research, just kind of follow the data as it tells us. But uh, you know, as of right now, it looks good.
hmm Now, you've got three columns here, as you mentioned. There's the trend, so what's going on with the price, where
Yep.
that's going in relation to the S&P 500, and then the money flows themselves. Is there one? Do you kind of weight these all the same, or is one kind of, because I'm noticing there's a lot of green on the trend, whereas it seems like the relative performance in the money flows maybe hasn't caught up yet. So, are any of these leading, or do you weight them kind of evenly? How do you kind of look at this and say, oh, this is telling me where the puck is going, maybe, as opposed to where the puck is right now?
I definitely look at it from left to right. I want to see price appreciation first. At the end
Hmm.
of the day, that's when you're buying an asset, you're spending the price. So I want to see a positive price trend. After that, I want to make sure that that price trend is appreciating more than we use the S&P 500 as a benchmark. So I want to see it appreciating more than the S&P 500. And then after that, I want the conviction of the dollars that are sticking into that particular asset. So I kind of look at it from left to right. I'm not, invariably, I want to see all green, when
Hmm.
I'm looking at these things. And we really use this as a top down report. This isn't a traded model. We suggest for our investors that are, looking to use this, or some of our research clients, that they, um, you know, tech is at their back. So if they have a tech stock that they like, they can get tech. Or if they've been looking to get into gold, this is maybe a good time for gold. Or
Hmm.
small cap, they've been screaming or waiting to get into small cap, and everybody's been holding them back. And now may be the time for them to start looking into those small cap stocks that they're interested in investing in. But yeah, I definitely, left to right, price is most important, how much it's appreciating, and then that conviction that money flow is really important.
Hmm. And in terms of your time frames here, is this all 21? Because your trend, your relative performance, your money flows, over what period of time are you looking?
We do keep the timeframes for this particular report in house.
Okay, gotcha. Okay.
We've done some testing and some strategic looking into what we find significant, but we have to leave something to the minds.
Some mystery, right? Okay.
Yeah, absolutely.
Well, you were talking a little bit about technology, so I wanna go back to the CEF model, and
Yeah,
as you said, kind of the standouts here are XLK, XLC, XLF, and XLY. Certainly XLK, XLC, and XLY. That's the technology, the communication services, and consumer discretionary. All of those are very top heavy in terms of their market cap. So you've got,
yeah,
your Microsoft, your Meta, your Alphabet, your Tesla, your Amazon. You know, in each case, it's like 40% of XLK, XLC, XLY. 40% of each of those is due to two stocks,
right.
in a lot of cases. So, um, does that ever get in your way, I guess, in terms of, oh, is this telling us about that sector, or is this telling us about those two stocks, that are kind of heading it up? Do you ever look at, like, for instance, RSPT, or the equal weighted, to kind of get more of a sense, or is that market cap, you feel, just a better way to go?
I think the market cap is just it. Not to be too glib about it, it kind of is what it is. I can't. It's the way our markets are formed. We have these
Mhm.
big cap, big tech stocks that are kind of able to drive our markets. And when things are going well, then people are interested in those companies. They have a lot of capital. They throw a lot of weight around.
Mhm.
So we tend to keep it in the fund family. Just into the sector spiders here. Not really looking into other sectors, or sorry, other ETFs with similar
Right.
blends. We've played with equal weighted, and sometimes try to use that as an indicator, but it hasn't really tested well for us in the past. So it's not something that we're driving home about. It might be a fourth or fifth level indicator that we'll look at, but nothing that's driving investment decisions.
Mhm. And if you don't mind, let's go ahead and take a little bit of a deeper dive, and get into some of the sectors and some of these areas, specifically. And XLK, as you mentioned, this is the technology sector.
Mhm.
This one has been top, but you kind of have this favored, neutral, avoid. And again,
Yep.
I think these are the numbers that you shared: favored 3 to 15, neutral 16 to 24, avoid
Yes.
25 to 33. So this has kind of been a little bit. I mean, look, everything was coming down, in March and April,
Yeah.
but has this, what is this chart telling you in terms of how technology has maybe not stayed as high as you would normally expect in a rally this strong?
Yeah, I mean, it did have what was it, 16 or 17 weeks where it was consistently in that favored ranking. What this chart is we call it our rainbow charts. Is the pretty colors, and it shows the daily CEF score for that particular sector. So you can see how this CEF model would be ranking this on any particular day. On the bottom half of that chart is the relative outperformance of that sector versus SPY. So it's XLK
Mhm.
versus SPY. Um, you know, we had technology had a great run, kind of coming off those April lows. You can see it went from a void, shot through neutral up into favor, and kind of stuck there for a while. And we did get some really strong relative outperformance from XLK during those times. And then over the last couple of weeks, it's been in and out. Money's flown in real strong, flown out real strong. We kind of track these flows on a consistent basis, and it's been kind of hard to peg XLK over the last couple of weeks. It's just, I think, again, going back to what we were saying earlier, I think investors are trying to figure out what's going to happen with this economy. The market's been going up for quite a while. We're hitting new highs. How long is this going to last? And XLK tends to lead the pack with those big cap stocks, like you said. So
Mhm.
we've been seeing money kind of flowing in and out, and as of right now, money's flowing back in, and we're testing relative outperformance highs again.
Mhm. I also wanted to kind of get your thoughts a little bit on utilities. Utilities is kind of down there now. It's in the avoid area, but for a while there, this was another one that was kind of getting correlated in a very different way. And look, it made sense. We were starting to call the utilities the AI adjacent play, because with the amount of power and energy that AI, the chips, cooling them down, all of this stuff, not to mention all these other, um, you know, taxing of the system in terms of your EV charging and everything like that. But it seemed like utilities were kind of going in line with AI for a while. Um, that's kind of come off. How are you viewing some of these things? Again, where the correlations to the norm of defensiveness aren't holding like they typically do.
Yeah, I mean, AI is largely what's been driving the market, right? We get really excited by AI, what it can do for the economy. Companies are able to theoretically cut employees and still keep their revenues high. I've been joking with my dad that utilities puts a mask on sometimes and pretends that it's a risk-on asset. So all that capex spending gets people excited. But at the same time, they remember that some of that capex spending is not going to turn any profits or revenues for 5, 10, 15 years, depending how long it takes to build some of these plants or some of these data servers or things of that nature. So it's again, that's one of the reasons that we created the CEIF model this way. Is there's a lot of that speculation, and I can tell you what I think, but at the end of the day, we want to know where that money is flowing, and we just want to watch the data. So in this case, this particular week or less, month really, because it's score of 11 in that tactical time period, has got money flowing out of utilities pretty aggressively. So we'll avoid utilities, and if it wants to behave like an offensive stock again and money starts flowing in, we'll treat it that way too. We follow the data to the best of our abilities. And while I am giving a lot of opinions, the way we invest is a little bit more data driven.
Mm-hmm. Well, and maybe you could kind of share some of the because you mentioned you've got a lot of different models and you also have a number of different portfolios because like you mentioned there was the aggressive portfolio.
Yeah.
Maybe you could spend a little bit of time just kind of talking about some of the differences in the models and which ones kind of again when you say aggressive, what does that mean? What makes it more aggressive?
Yeah. So we started managing money about a year ago, and
Mm-hmm.
we built these 4 model portfolios on top of our models, our CPM model, our CEIF model, and
And just I'm going to interrupt you real quick. So the
yeah, please.
CPM, that's your correction protection model,
Correction protection model. Yes,
if I
sorry.
remember correctly. Yeah, right.
I
So
have been, it has been a part of my childhood, so I forget that people might
exactly.
not remember exactly what it
Well,
is.
and CPM for a lot of people means cost per thousand. So for the
That's,
marketing folks, yes.
absolutely,
Yeah.
absolutely. So yeah, I apologize. Yeah, so no, we blended the models in different weightings. So our aggressive model actually uses SSO a little bit to take on a little
Hmm.
bit of leverage. It gives you that juice, and to use the correction protection model, as I was mentioning earlier, willingness to take on a little of that leverage, knowing that I have the downside protection of that model. And then we span the gap. We have an aggressive, a balanced, and then we go all the way to an ultra conservative model. Um, that one has a large portion of BIL, which is the Lehman 1 to 3 month ETF, giving you, I think, roughly a 4.25
Hmm.
yield at the moment. And that one is for older investors that are taking drawdowns, and that model hypothetically back tested going back the last 6-7 years has had a max drawdown of only about 9%. And we've seen upwards of 33-34% in the S&P 500. So we try to allow our investors to kind of pick from a smattering of different risk profiles to align with their investment goals.
Yeah, and I should say before anyone gets scared of how this chart looks for BIL, it has distributions very often, and that's
Yes.
what you're seeing here is these distributions. And also remember, this is between 91.8 and 91.4 for the most part. It's very stable in that regard, and you can see that on well. Yeah, this chart really shows that stability, the weekly chart.
Well, and when you got
So
1 to 3 month T-bills, there's a lot of churn as well. They got to keep making new purchases, and
yes. And, to that end, you brought up SSO, and that's one of the things, when you get into some of these leverage products, a lot of people get concerned, especially with the inverse leverage, where, you got the contango, right? Because, in the same way, when you're rolling those, rolling those futures contracts and everything to obtain that leverage, there is a little bit of a degradation there. Uh, a lot of times people are looking at the leverage, and get cautioned. Okay, this is for short-term trading, right? This is for it's meant to do a daily. It's not meant for monthly or holding for a year. So when you're using some of the leverage in like the aggressive portfolio, how are you shifting that time frame for some of those limitations of the leverage products?
I think again, our understanding is when you know, we're never. I don't look at us as ever naked to those levered products because
Hmm.
we're have the underlying of CPM, and I look at the risk, kind of the risk metrics of CPM, understanding what my drawdowns are, understanding what my standard deviation is, really kind of understanding what my risk is as a whole. So we feel comfortable using some of these levered products because we have our downside protection of our model.
Yeah.
I
Hmm.
don't think I would ever just trade an SSO naked or hold it for long term because there's a lot of risk involved in sitting on those. But when we've back tested those type of products with our model, CPM model, using those signals, it gives us that ability to have a little bit more comfort in using them a little bit longer long term and not have to. I can sleep a little bit easier knowing that I have that model at my back and I can
Yeah.
take advantage of that upside.
Hmm. And at the end of the day, again, it, it's a market timing, kind of model, right? Where
Yes.
that's where the protection comes from. And so, yes, you would expect, especially to get a harder hit, and it's tougher to recover sometimes. But if you don't take the hit, you don't need to recover as much. So you don't put yourself into that situation. Um, Now, what about kind of, I guess, these sideways periods? I'm gonna pull up SPY real quick and just kind of point to lately, in August here, where we had this kind of sideways period through a lot of that. Are you putting any seasonality into this? A lot of people talk about the sell in May go away, or how September, tends to be a rough month. Bottoms tend to happen in October. Any of that that you overlay in your models?
We really don't. Our models have a series of indicators that we're kind of utilizing. Again, the seasonality and those different sayings. I think back testing them doesn't always work. So we use them as secondary, third indicators. Directionally telling our clients where we see things are going. But when it comes to our models, very numbers driven. Try not to leave any anecdote or opinion to it because again, at the end of the day, we don't want our emotions to control our investing style. We want to,
Hmm.
we came up with some really nice systematic tools that we use, and trusting those tools has done us well instead of trusting our opinion or getting caught up in the fever of the daily online media onslaught.
Right. And because again, we usually talk about the Asbury 6, and again, that's, kind of letting you know where the market is at. Would you mind kind of giving us an update on some of the correction protection model, the Asbury 6? Are things still flashing green for the most part, or I think one time your dad was on, John Kosar was on, and he was talking about how there was a lot of blinking, going on. They would be kind of blinking on and off. What kind of environment have you been noticing in the correction protection model and the Asbury 6 in terms of the strength of the market overall?
Yeah, I believe I apologize, I don't have the graphic, but I believe the A6 is currently 3 of 3 today.
Hmm.
But it has been risk on for the last couple of weeks, as has our CPM model. So, again, there's been some wiggle. We've had some wiggles here and there, but largely our models have kept us risk on. And yeah, it's both of them have really performed well even throughout some of the turmoil in April. And we've caught a good chunk of, if not most of this rally since April 24th. I think
Hmm.
we had one little wiggle in A6 in June, but otherwise we've been risk on, and it'll take the Asbury 6 to go 4 of 6 red to go risk off. We're 3 of 3, so we'll see what tomorrow brings us, but we will just follow the data, and as long as our models tell us to stay risk on, that's where we are.
Awesome. Hey, any final thoughts before we wrap this up?
I just last couple times I've had some interviews and things of that nature. I've asked me as a young person, what am I taking to this? Taking to investments and learning from my dad and him having 40 years of experience. And I think again, just the ability to be more data driven,
Yeah.
to take the emotions out. As a young guy, I'll sit next to my dad like, I think it's a top, and he like, hey man, just
Relax.
just relax a little bit. Let the data point you to the direction. So I think again, at the end of the day, we sit with the numbers. It helps me calm some of my excitement down when I think I have the newest, greatest, and latest indicator. And just follow the data.
Yeah, and I mean, there's such wisdom there, because again, a lot of times it's so easy to, especially if you're like listening to news, you're listening, or you're looking at intraday charts, you're just
Yeah.
kind of, but a lot of your stuff, from Asbury Research is kind of done on a weekly basis, and so there is that kind of purposeful step back. Let's not react too quickly. Let's kind of see how things end the week, and yeah, a little bit
That's
calmer.
Yeah, the CEF model, we get asked questions all the time. Why don't you just use the weekly flows? Why
Mm,
do you include the monthly and the quarterly flows? And it's because, you have to sometimes allow these trends to take into effect. And you can watch the tick to tick moves every day and it will get you off sides. So, we include some of those more historical data points with CEF, and just to keep us on sides and not get thrashed around on intraday and day-to-day moves.
mhm. Well, Jack, it was a pleasure talking to you again. Really appreciate your insight here, especially again on some of the newer indicators that you're looking at, some different ways of looking things, and again, getting the next generation involved and seeing what you guys are up to. So appreciate all your insights.
No, thanks, Justin. This was a lot of fun.
Yeah, and as a reminder, folks can go to asburyresearch.com, and I know that you often offer deals for IBD folks, but yeah, that's a place where you can find out more about the Kosar family, John and Jack both. So thanks again, Jack. Really appreciate it.
Thanks, Justin.
Okay, that's going to wrap it up for us this week. Thank you so much for watching. And next week, guess what? We've got what my producer was calling VIP, more because he signs our paychecks. It's Chris Gessel, our Chief Content Officer, the boss of myself and Mike, our producer. So we're going to have him on, getting through a lot of models that he's going through in the markets and how he's handling some of the hedging. So yeah, we're gonna really do a deep dive on some of the newer indicators he's using as well. So hope you join us for that. Chris Gessel is always a fun time, and he would also want me to point out he's not just my boss, he's my friend. So hope you join us for that. We're going to be live at 5 p.m. next Wednesday. We'll see you then. Take care, everybody.